alaikum, listeners. Welcome back. I hope all of you are fine and doing great. I'm here to discuss some uh, basic details of temporary and the permanent tax differences. We have done this topic in chapter number 15 of corporate financial reporting, where we were calculating the temporary differences and the permanent differences, or you can say the differences which give rise to the deferred tax liability or deferred tax asset known as temporary differences. We have made the discussion about this. Here is one exercise in which we will be trying to figure out what is the amount of temporary difference and what is the amount of permanent difference. Before reading the content of this question, I will just recall some points with you that accounting books follow GAAP and IFRS principles, whereas textbook follows the tax laws of that particular country. Most of the things which gives rise to which gives rise to incomes and you can say profits or the expenses in the accounting books, that does not give rise the revenues and the expenses in the tax books because of the differences. Do remember those differences which give rise in accounting books. Let's suppose this is my tax books and this is my accounting books. Those differences which are giving rise to revenue or expenses in accounting books in one accounting period and does affect the tax books in another accounting period, those differences are known as temporary differences. And because of temporary differences, we are having, ignore the spellings please, RARY. Okay, temporary differences. So those differences which are temporary in nature means in accounting books the revenues are more because we recorded the revenue, but in textbooks we will be recording the revenue next year or after that year, but we will ultimately record it. So these are the temporary differences because ultimately both books are going to be affected. Same is the case with the expenses, those expenses which affects the accounting book in one accounting period and in another year they affect the textbooks. Those expenses gives rise to the deferred tax assets or deferred tax liabilities, or you can say they are known as temporary differences. So deferred tax assets and deferred tax liabilities have a relation with the temporary differences. There are some differences which are permanent in nature. It means that they affect, for example, the accounting books, but they never affect the tax books, or they affects the textbooks but they never affects the accounting books. So they are permanent in nature and they do not give rise to the deferred tax asset and deferred tax liabilities. This was the one main topic which we have discussed in chapter number 15. There was another important thing which we have discussed, that was every year the tax we pay, that is paid according to the tax books, whereas the real income tax expense is based on the accounting books. So for example, your tax expense is 10,000. This is income tax expense. This will be in accounting books. Income tax payable, I'll write here tax payable, that is based on textbooks. Difference between these two amounts, let's suppose it's 12,000. This is going to be temporary difference if it affects the accounting books in one period and the textbooks in another period. It will be permanent difference if it is never going to affect your one of the statements. So in this question some information is given to us, and based on that we need to figure out what is the amount of the permanent difference and what is the amount of the temporary difference. So let's read it out. Hernan Company reports the following information for the year. Book income before the income tax. Book income means accounting rules book. That is 636,000, and this is before the income tax. Income tax expense, this is also in accounting books, that is 312,000, because I said that the expense is based on accounting books. Income tax payable for the year is 96,000. This is based on tax books because this is calculated based on tax. And what is the rate of the tax? That is 40%. The company has both temporary and the permanent differences in the book income and the tax income. So we need to calculate both of them. Look at the point number 1. What is the amount of the temporary difference for the year? And also we need to indicate that it makes the book income larger or the smaller than the taxable income, means tax income. And the point number B is asking about the permanent differences. Do remember, the tax expense in the tax books and accounting books tax expense, they are different because of the permanent differences and temporary differences. Temporary differences give rise to deferred tax asset or deferred tax liability. So let's try to figure out what are the temporary differences and what are the permanent differences. I can take the help of deferred tax liability to calculate the temporary difference. How can I do that? Look at this. When I will be recording the journal entry, so in the journal entry, my income tax expense, it's already given, that is 312,000, right? So I will be debiting income tax expense with 312,000. Okay, and income tax payable will be it's already given 96,000, so income tax payable will get credit with 96,000. My debit side of the transaction is not same like credit. There is a difference, and we all know that that is known as deferred tax liability, right? So the difference between these two amounts is 216,000. So I have calculated deferred tax liability. So this is what I did. I have compared the income tax expense with the income tax payable, and the difference is deferred tax liability because the journal entry will be like that. Since I get the deferred tax liability, it will help me in calculating the temporary difference. Okay, so what does this means? It means that the temporary difference is when I multiply whatever is the temporary difference between accounting book and textbook, if I multiply it with 40%, I will be getting the deferred tax liability. This is the formula, right? Difference, because deferred tax liability is always because of the temporary difference. So temporary difference multiplied by tax rate, I will get deferred tax liability. So this is what I'm doing over here. I know the deferred tax liability, I know the rate, but I want to calculate the temporary difference. So I'll simplify this expression, keeping the temporary difference on this side of equation and taking this 0.4 to the other side of equation. So it will make the deferred tax liability with it will become denominator. So deferred tax liability divided by your rate of tax will give you the temporary difference. Okay, so in this way, when I solve this expression, deferred tax liability is 216,000 divided by 0.4, so I get the temporary difference. Now let's compare. They said clearly that there is permanent difference as well, right, between the tax books and the accounting books. So basically, if we have taxable income in textbooks, taxable income means I have to charge still the tax on it, okay? And I have pre-tax income in accounting books. This is my accounting books. They should be same. They will not be same when I will be having the permanent difference and the temporary difference. Since I get my pre-tax income already from the question, so I can compare now, right? So see here, the pre-tax income is 636,000. So pre-tax income in the accounting books is 636,000. Taxable income in the textbook I need to calculate because they gave me income tax payable. So it means that whatever was taxable income in the tax book, I multiplied that with the tax rate, so I get 96,000, right? So if I want taxable income, I can divide 96,000 with zero point 0.4 and get my taxable income. So when I simplify this, look over here, I get my taxable income of 240,000. So taxable income is 240,000. They are not same. Accounting books has 636,000. Tax books has a pre-tax income of 240,000. We know there are temporary differences. Okay, we just calculated that was 540,000. So 540,000, I get the temporary difference. Now if I check my taxable income in the tax book, that becomes 780,000, like I did over here. It is not equal to accounting books pre-income. So why they are not equal? They are not equal because still we have permanent difference. So the difference between both of them is permanent difference. Now can you see? So I added the plug by comparing this with this. So the difference between both of them is 144,000. So this is permanent difference. So I solved this question in a reverse calculation way, that I took the help of journal entry to record the tax expense and income tax payable, and from there I find out my deferred tax liability. Deferred tax liability has helped me in calculating the temporary difference, and then comparing tax books taxable income with the accounting books pre-tax income and adding the temporary difference helped me in finding out my permanent difference. So this is how we need to solve this question. I hope you understand it. If there is some confusion or anything you want to ask regarding this topic, please don't hesitate to write in the comment section. Inshallah, I'll try my best to answer on time. Take care everyone. Have a nice day.